Welcome to the Jones Zone, a podcast by Darryl and JJ Jones.
Hello, everybody. Welcome to another episode of the Jones Zone. Today, we are joined by Matt and Johnny. They work for a company called Tax Alpha Companies. They have to do with 1031 exchange. And for those of you who don't know what a 1031 exchange is, it's basically a tool, and I'll let them explain it really, but it's a tool that homeowners, investors that own rental properties use to defer taxes. So, Matt, Johnny, which one of you wants to start and kind of explain a little bit, maybe what a 1031 exchange is better than I just did, and then also what your company does and the options for people who do own rental properties, what options they have. I've done many where it's basically they sell a rental property and they buy another rental property and they defer paying any capital gains tax.
Hit him with it. Go ahead. What's the 1031? Tell them what
Yeah,
1031
yeah. So, one of the things we do is we help individuals who are undergoing significant life transitions, and the 1031 exchange is part of that. It's part of the tax code, and it allows somebody who owns investment property to sell that asset, and usually they'd want to sell that if they've got that asset's highly appreciated and they didn't want to pay taxes. They could use the tax code 1031 to sell that asset and exchange into another asset completely tax deferred, right?
Yeah, so you don't have to pay taxes. And it's interesting because you have to have what's called an accommodator. Do you guys have to have an accommodator to buy your product or what you guys sell?
That is correct. Accommodators, often called a qualified intermediary or a QI, right? And really all that does for a client is helps them avoid constructive receipt of the funds when they sell something. Because if I sell it and I take the proceeds and I commingle it in my account with a bunch of other money, I have lost the ability to do a 1031 exchange. So avoiding constructive receipt by using an accommodator or qualified intermediary is the first step in a process of a 1031.
And the main reason why someone would want to do this is, it's funny, I was actually just talking to my wife about this. I was under the false impression that you could restart your depreciation of the property, but you can't. So the main reason people to even do 1031 exchanges would be to kind of get themselves a larger property, a more expensive property, and leverage those funds. Would that be fair to say, or?
Would be fair to say. So one of the unique things about the reason the code exists, look, many people have been critical over the decades that 1031 has been part of the IRS revenue ruling, has been, how do you let a rich person sell a highly appreciated piece of real estate, not pay taxes on it? That sounds like a bunch of crap, right? Well, the reality of it is the reason the code was created was because of what they call economic growth or expansion. So if I have to buy a larger property than the one that I sold, then what happens when I buy a larger property? I probably take on a larger mortgage. A mortgage broker made some commissions and fees along the way. I have to hire painters and plumbers and roofers and all those people that are going to turn that property, that new vision of that rental or investment property, into what do they call it in real estate all the time? Highest and best use. So if I bought something that's bigger than what I owned before, I put capital expenditure in it, typically referred to as CapEx, and I turn it into a bigger, more robust property. I've created jobs. I've created income taxes. I've created a lot of other revenue along the way. And by the way, there's an annual report that's kind of written every year on the economic value and the trickle-down benefits of deferring the capital gain for a seller. And the net benefit to society as a whole is more jobs and more taxes paid by allowing the seller to not have to pay taxes on a capital gain when they transact on a larger piece of real estate. So it spins the flywheel of commerce. And Darryl, I'm even going to bet every once in a while it helps a guy like you get a sale.
Well, I tell you, you run for office, I'll vote for you. So that was very enthusiastic. I liked it. So Tax Alpha Companies, we specialize in helping real estate investors legally reduce their tax burden through advanced strategies like 1031 exchanges, Delaware statutory trusts, and more. Explain tax advantage private equity. How about let's go into that. Tell me what it is your company does.
Sure. Not a problem at all. So look, I've been doing this for 2 decades. I have a real estate background. I have a construction background. I'm a general contractor. I have a graduate degree in finance and a whole bunch of other stuff. What I learned along the way is there's a lot of people that want to do real estate and take it to highest and best use, like your guys that do your single family homes, your fix and flips, you own them for rehabs and then cash flow them, right? But some people aren't as good at that as others, right? They realize, man, I'm not so good at necessarily doing that side of the business. I just want to be more of a passive owner. So then they become a passive owner of real estate. And then what do they got? Toilets, tenants, trash, taxes, and all the other stuff associated. And they're like, wait a minute, this is way more complicated than the podcast I listened to made it sound like it was going to be for me to be a real estate owner, right? So they go, but I still have read all the books, Rich Dad, Poor Dad, and all the other things that says owning real estate is a really good thing. So how do I become an owner of real estate without all the responsibilities of ownership of real estate? Give me all the good stuff, take away all the bad stuff. How do we do that, right? So private equity real estate, in the way that we view it, is pretty simple. It functions under partnership law. Partnerships, you have two things. You have a general partner, the guy that knows how to do the thing, the guy that knows how to turn money into more money, the guy that knows how to maximize the value of real estate to highest and best use and generate cash flow and get your cost segregation studies and generate your passive losses and can manage it to an institutional standard. And then you've got your limited partners, the person that brings the money to the deal. So a limited partner brings cash, a general partner is the expert, and they partner together to split the profits in some capacity while turning real estate into more money. Not really any more complicated than that in the grand scheme of things.
Yeah, because what you're kind of replacing, for possibly that's the right word, is from what you mentioned, those people who are selling a rental and buying another rental property and are just sick of fixing toilets, sick of having to get calls at midnight about a water leak, or sick of trying to get rent, property management in general. Because so I think that's really the big value there, is because, and there are a lot of people who want to sell their rental property, I think, and buy, well, your product.
Well, I would argue this. I don't think they even know our product exists, to be fair. And I've been doing this for 2 decades. We don't compete against somebody choosing to do or not do what we do. We compete against ignorance or lack of knowledge in the marketplace and them not understanding that this is a viable option, right? But what's the cathartic moment that the average real estate investor goes through? At some point, they get tired of the calls like you're talking about in the middle of the night, the toilets, tenants, and trash. And then what happens is they go, you know what? I'm going to stop raising rents on my property, and I never want anybody to move out. I never want to put any CapEx into the property again. The property continues to appreciate in value, and now they're getting a really terrible net cap off of their real estate. Their cash flows are like a 1 or a 2% off the value because they just don't want anybody to move out because they don't want to have to re-tenant it. They don't want to have to deal with it. But eventually they go, man, if there was they switch property management companies because they think the grass is greener.
Which costs a fortune, these property management companies, I tell you. And there's a reason why it costs a fortune, because it is a pain to manage properties, but it's a good 10% typically. So if you're collecting $3,000, $300 gets taken right off the top. I didn't mean to interrupt you. You're on a roll.
You didn't. You're right. But
Okay.
but that's the whole point, right? Look, I've even personally owned rental real estate in my day. I've bought multiple properties that I've owned, and I've done all this myself. And I would do the calculus on my real estate personally, and I'm trained to do this. And my real estate would be, I'd get my net would be 2, 3, 4% on real estate. So it wasn't like I was crushing it from an income perspective. Now, did I buy good real estate at good prices and did it appreciate in value? Yeah, but that's not putting cash back in my pocket right now while I'm owning the real estate. So there's not all this fallacy of passive cash flow. It's just going to flow in and flood my mailbox and replace my job and stuff. I think that's kind of a misconception that's been put out there. So where we step in is when somebody understands the value of real estate, but realizes no matter what they do, it's hard unless they're doing it full time, right? They've got a job. They've got other responsibilities in life. They've got family. They've got kids. They've got all these other things. They can't be dealing with this real estate all day, every day and maximizing the value of the real estate. When they get to that scenario, whether they're younger or older, and it typically happens as people age, they learn along the way. I can't deal that with anymore. Like I got a client right now that are in their 50s, early 50s, selling their real estate portfolio in the millions, and they realized we want to spend more time with our kids as our kids are growing. They only get to grow up once, and we want to be present. We don't want to be not at their soccer games on the weekend because we're fixing houses, rental properties that have appreciated and been great real estate investments, but it takes time away from the most important thing in their life, their family. Now, it's super common that it happens when somebody gets older as well. You built your net worth, your real estate's appreciated in value, you're 65, 70 years old. You're like, woo, I'm tired of doing this. I've got a bunch of cash flow. My real estate's extremely expensive, but I don't want to pay taxes on all this when I exit. And Darryl, you're out there pounding the phone and you're calling them and you're like, I know you're ready to sell that property. The market's hot right now. I can get you a premier price. At the end of the day, sellers only want to do three things. What do I do with all this money if I sell? I can't just park it in the bank. How do I generate cash flow from this money if I sell? Because we don't live on assets. We don't want to cannibalize our capital base. We want to preserve our capital base and generate positive cash flow off of it. And how do I do all of that without paying taxes? And the only way that they can do that is by understanding how 1031 works and then potentially understanding how being a limited partner in a general partnership structure would be beneficial to their life.
And to remind people, this is not for primary residence, it's for rental properties or investment properties. Let's take a step back and explain even the rules of a 1031 exchange. For example, so if one wants to sell a rental property, they have to identify where they're going to be parking that money, for lack of a better term, within 45 days and then closing that escrow within 6 months. What are the rules? Am I missing anything else in terms of the rules? You have to get something equal or greater value to get the full benefit of the tax deferment. Is that correct?
Johnny has done more 1031s than anybody I know from an operational standpoint. And that's what you're asking about, the operations and mechanics of what it takes to do it. Johnny, tell them what it takes to get a 1031 done.
Yeah, so I'd say that's mostly correct, Darryl. But I think that the most important part when you're looking at a 1031 exchange, when I'm talking to clients about a 1031 exchange, is the planning and the process. Because what a lot of people do, especially having been, let's call it, for lack of a better term, amateur investors, right? If you don't do it full time, you're basically an amateur real estate investor. Is they wait until they're basically sold the property to turn around and go and look for more property. Right. And so that's when that 45-day timeline goes into like a tight squeeze, right? Especially, depending on the market. And so what I like to do is I like to coach people through all the rules, right? But when to start to consider looking at a 1031 exchange and planning it out several months ahead so that you're not worried about your 45-day timeline. Because as you know, Darryl, let's say somebody's going into another property, right? One of the things, or some of the things that they have to do on the next property is due diligence, right? And once you've identified property in the first 45 days, you can't go back and choose another property once that 45-day period has passed. So I've had people identify properties past the 45-day and fail like a big environmental inspection, right, on the property. And so there are ways to plan this ahead so you're nowhere near failing your exchange. And so oftentimes when I work with people who want to work and look at this ahead of time, I'm actually able to get them closed and into their next property just a few days after they've closed on the property they've sold. I've gotten them into the property that they want to buy next. There are a lot of rules, but you also want to make sure you're adding in the planning process for that, right?
Yeah, and one could even do a reverse exchange. That's potentially a thing, which is buy first.
That's
But
right.
so how does your product work? I mean, what is it? Explain, because it's not buying another rental property. I mean, I know that Matt explained it somewhat, or so either of you can chime in. What exactly is your product? It's a general partner and a limited partner. Maybe talk more about what that is, and is that something where that person doesn't even have to find a specific property? They just tell you. Walk us through that.
Look, the average person is going out there trying to find what they think that they can buy, right? I've got a $500,000 exchange. I'm trying to find a $500,000 home that I can potentially buy. So they've really limited the scope of the types of assets that they can look at because they've only got $500,000 to go shopping, give or take, whatever it is. But imagine for a minute, suspend disbelief, that all of a sudden every asset you drove by on any daily basis that qualified as investment or commercial property was eligible for you to put your equity inside that deal. So let's visualize that for a minute. What is that? Imagine apartment complexes, self-storage facilities, Amazon distribution warehouses, hotels like you see on the side of the road, or I'm in a hotel right now. I'm speaking to you from a hotel room from Marriott, right? So imagine that instead of having to find a home, you're like, I could put my money into a Marriott. And you're like, well, with $500,000, I can't possibly buy a Marriott. And you're right. but you might be able to buy 1% of a Marriott. And if we own with other investors the whole Marriott as limited partners, and we have a general partner that knows how to own and operate hotels and maximize efficiency, well, guess what? I own 1% of the capital appreciation, I own 1% of the passive cash flow, and I own 1% of the tax benefits without any of the hassles and responsibilities of having to do it whatsoever. I let the general partner manage that asset for me. So it's a fractional interest of an institutional asset, and I own that fractional interest in its entirety. And it's just managed by somebody else. I've given up operational rights to somebody who's exponentially better at this as a professional than I am.
It almost sounds like you're buying stocks. it's not, but it's kind of like that, to where you call you or someone and you tell them, okay, I'm doing an exchange. I got 500,000, and you go, okay, great. I'll put it in here. What's that phone call look like? So I call you. I've got 500,000. I've got a rental property. It's an escrow. I'm going to have $500,000 to invest. What happens next?
So I'm going to answer a question that you asked on the pre-call, because everybody's going to have the same question. Is it a REIT, right? And so that's
a real estate investment.
Real estate investment trust is the underlying assets of it are real estate, and it's put in a securities wrapper over the top of it. So that is a financial product out there. What I'm talking about is not a REIT. That is not how it functions. The underlying asset, once again, is physical real estate, but it's not in a REIT structure. It tends to be in more of a partnership type structure that can be called, you could have it called a TIC, a TIC, which stands for a tenant in common. You can have it in a DST, which stands for a Delaware Statutory Trust. And then sometimes for some of our investors on larger transactions, like for example, I was doing a transaction with a customer out of New York just a few months ago, and he had millions of dollars to exchange out. Very sophisticated investor. Well, I connected him with one of the partners that we do business with on a regular basis. They liked each other and hit it off. And he goes, man, I own this hotel in Tampa, Florida. What if I just exchanged your money into my hotel and recapitalized it, and I took $3 million of chips off of the table? So it ended up being a pure 1031 exchange into a completely off-market opportunity that no one would have ever talked to anybody about, because I just happen to know a guy that owns $1 billion worth of hotels and was like this guy enough to offer him a fractional interest of one of his hotels.
Wow. Very interesting. So I'm not that $500,000 guy, the billionaire, but I've got a rental property I sell for $500,000. I call you and go, okay, Matt, what happens next? We wait for it to close escrow, and then it just simply walk us through that like I'm a 5-year-old.
Sure. And you're not a 5-year-old. Very sophisticated compared to any 5-year-old I've ever dealt with.
Well, I meant our audience, but anyway, I'm just kidding.
You go. Them as well.
I'm just kidding.
So look, when somebody's going to go hard on their contract, right? So now they kind of know what the terms are going to look like and when they're going to close.
Go hard means everything's agreed upon. They know it's going to sell for 500. Just for people that don't know, there are little words that we use.
Good call. I appreciate that. Absolutely. So your contract is ready to go. You're expecting your close date. You know kind of your terms. You have an estimated settlement statement on what that's going to look like, which has, here's, if there's any debt that needs to be paid off, if there's, here's the equity you're going to receive, here's your transactional closing costs, here's what you're paying your broker and the title company for the title search and all that other stuff. You have an estimate of what all those line items are going to look like weeks in advance before you actually get to the closing table. So at that point, you're going to kind of reach out to, and build a relationship with a qualified intermediary, let them know that you've got some money coming in the future from that transaction, and you don't want the money to go from because when you close, they ask you, where do you want the money to go? Well, I don't want the money to go to me. I want the money to go to my qualified intermediary. So you make that introduction so that they know who to send that money to when that check closes. At that point, we know how much equity they're going to receive. We can also then, what we would do is we run a tax analysis on our side to determine for the seller what the taxable event is ultimately going to look like. Not everybody does that. Not everybody has a CPA that's qualified to do that or does that as a regular scope of work. So we talk to the client and go, do you want to know what a taxable event would look like if you cashed it all in? Do you even know what that would look like? So we have to calculate their cost basis, what they paid for it, any capital expenditure they put into it, additional money they pumped into the property to increase the value, right? Then we're looking at things that have taken away from the value on paper, depreciation or accelerated depreciation. And so that helps us get to what's called our adjusted cost basis. So our adjusted cost basis is what we fundamentally paid for it. And then the sales price is what we're selling it for. The delta or the spread between the two is the taxable event. If we've held it for less than 12 months, it's short-term capital gains, which converts to ordinary income and is taxed at our highest bracket, which is 37% federal plus state.
12 months or 24 months?
12 months.
Oh, okay.
Yep, 12 months and a day is long-term capital gains.
Okay.
So
That's right. I'm thinking of a primary residence. If it's a primary residence, I think they have to live there
that's
2
right.
years.
That's
Okay.
right. You get a gain exclusion under 121 if you've held it for 24 months or more. That's right.
Okay.
Absolutely correct.
Forgive me. Continue, my son.
250,000 for a single person, 500,000 for a married individual becomes a gain exclusion if you've held a primary residence for 2 years. You are absolutely
different topic, but go ahead. Sorry.
Yeah, no, but it's applicable. So in this scenario, so we know what our basis is, what we paid. We know what we're selling it for. The difference between the two becomes our taxable gain. If we've held it for longer than 1 year, it's long-term capital gains. Federal, that's 20% rate plus state taxes if they're applicable, depending upon your jurisdiction. So now they know if they don't do a 1031 exchange, how much of this money am I going to end up with? Because what's my taxable scenario? So then we talk about what all the options would be. Pay the tax is an option. Pay some of the tax is an option, or pay none of the tax, potentially deferring it. And we're talking about 1031, but there's other codes that we could out there use. Maybe that's outside the scope of this conversation, but what we try to do is we try to loop in the professionals that any real estate investor has ever worked with. So if they have a CPA they trust, if they have a business partner they trust, if they have a real estate or a tax attorney that's part of their team, we are not a divide and conquer. We are a collaboration. Let's make the whole pie bigger and let's add value to those customers. So now we take their dream team, we sit at the table with them and we go, this is something you should consider and this is how it works. After the tax analysis, sometimes we tell a client, your tax bill's not as big as you thought it was. I probably wouldn't do this because there's rules and restrictive covenants around it, and it's probably not worth it for a $10,000 or $20,000 tax bill. You probably should just pay the taxes and then move forward with your next real estate investment however you please. But if it's a substantial tax bill that would be due, then we talk about what the options are to potentially mitigate that substantially larger tax bill.
Who chooses where that money goes? Obviously, it's their money, so they have some sort of input. Do you give them choices, like you mentioned, a hotel or something like that? What's that look like?
So we always do. So nobody's ever said diversification was a bad thing, right? So we have the ability to diversify a client. And one of the things when you do a 1031 exchange is you can identify really easily up to what they call the 3-property rule. So I can have 3 properties that I can identify in my 45-day window that I can potentially close on.
Let me ask you this. Would they contact you and let's say just you would be one? And then let's say they think, well, I might buy this condo, I might buy this other house, or I might invest it with Matt and Johnny. Can Matt and Johnny be one of those choices, or does that make sense?
Yeah, as identification.
Yeah.
For the ID form, for the tax form, it's got to be a specific property, but it's a great question. It comes up all the time. People always ask, can I just say tax alpha companies and identify that on the line? Unfortunately, no, that doesn't work. You do want to identify a specific property, and then we'll be able to show you specific properties. Difference being, I talked about due diligence in the 45-day and trying to do that in 45-day before, where you don't know anything about a property. If you're buying it the traditional way, right? We actually get to show you all the information on the property, the appraised value, all the inspections, everything that was done in a big legal document that you'll get to review before you even decide whether or not you want to invest in the property, right?
So you have like a portfolio of properties. You're like the MLS almost. I mean, you have here are our choices. Is that fair to say?
It is fair to say. And listen, I always ask investors, do you have something if you sell this that you want to buy? I asked them first, if do you want to do this? Do you have something you want to buy? I'm happy to take a look at it and show you how to identify what you want to buy. And if they have something or 2 properties, then we put those couple of properties in there. And then what we recommend is in a worst case scenario, we'll go, so what other assets have you ever thought about owning? Would you want to own multifamily? Would you want to own storage? Would you want to own industrial? Would you want to own a hotel? Like, we have all types of assets. So we go, what would you want to own if you in a perfect world? And then I say, where would you want to own it? Do you want to be in the Southwest? Do you want to be in the Southeast? Do you want to be in the Midwest? Do you want to be in Texas only because you like the politics or something? Who knows, right? But customers are funny sometimes about what they want to own and where they want to own it. They believe or have a belief system that in certain areas they know more about real estate than they do in other areas or certain types of asset classes. So we can diversify by who the general partner, or commonly called the sponsor, is. We can diversify by asset type. We can diversify by geography. And we can even build a portfolio that diversifies with something that they want to acquire, also with something that we pick out of our portfolio. At any given time, we could have billions of dollars of pre-vetted, pre-due diligenced investable assets at any given time. So for them to have something they like and us to have something we like, and them to identify at a minimum 3 properties. And here's the reason you want to identify 3 properties. This is a sneaky, sneaky little thing. If I identify my property that I know I can close on 100%, and the client wants to go out and negotiate a heck of a deal on a property that they want to get themselves using somebody like you, Darryl, they can then look at the seller of that other property and they can say, hey, listen, I've already identified another property that I am really excited about closing on. But you know what? I kind of like your property too. And if you and I could come to terms and I could get a great deal on the property that you're selling, I would be willing to exchange into your property. But make no mistake, I've already found something else I love. It's already due diligence, and I'm ready to close on it if we can't come to fair market terms.
They can come to you and say, yeah, I like that storage idea. I want to get a storage place in California. And let me ask you this. I kind of reverse this. I'm sorry, I'm going a little off here, but it just occurred to me. Where do you get these sellers of these properties? Or these, I mean, the storage area that you may put me into, how do you get that? How do you get those sellers? Am I making sense?
Yeah. So let's just say that, okay, they're not exactly sellers in the context in the way that you're using it, but it's a fair question. So these guys are called sponsors, right? And their job, what they do for a living all day, is go out and manufacture real estate from the ground up most times. So these guys are huge national developers. We have about 200 institutional relationships with guys that manufacture real estate from the ground up. So just like Aunt Jemima makes pancakes, Betty Crocker makes cookies, these guys manufacture real estate to an institutional standard. So once they've made real estate, what they want to do is they like to recap it and put some limited partner dollars into their deal, take some of their money off of the table, and let them use capital to go build and develop a new deal. Our guys have made the real estate, and this is part of the monetization for them, is at fair market value, selling fractional interest of that real estate so that they can take their chips off of the table and go start and do other real estate deals, because they're in the business of turning money into more money by creating real estate.
Part 2 comes out next week. Stay tuned, only on the Jones Zone.